Assalamualaikum to the viewer and our beloved lecturer Rabiatul Alawiyah binti Zainal Abidin, or we call as Ananda. Before I start, I will introduce all of my group members. First one is Nur Izzati binti Muhammad Sofyan. Second is Nur Liana binti Jamil. Third is Putri Nur Ain Zurin binti Jamaluddin. Fourth is Aisyah binti Arifin. And the last one is me, is Muhammad Aidil bin Zahano. So today we are from JBA2724C. We'll presenting about the features and options by using a past year question. The topic is about hedging, speculate, arbitrage, intermonth spread, and intermarket spread. So now let me move to another things. So now we are moving to first topic, which is hedging, that will be presenting by Nur Izzati binti Muhammad Sofyan.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Izzati and I am going to discuss about question 3A from past year question of FIN645 or 549. It's specifically about hedging FKLI. In early June, you manage a stock portfolio worth Rm20 million. Your portfolio is 65% more volatile than the market. You are very concerned with the market short-term volatility in reaction to the depreciation of Malaysia ringgit. Currently, the FPM KLCI and September FKLI are quoted at 15.36 and 15.33 respectively. You wish to protect the portfolio value against price risk using future contract. Okay, to answer the first question is calculate the number of contract to trade if you wish to protect 90% of the portfolio. Okay, number of contract is portfolio value times percentage of hedge times beta divide future value times contract size. As we know, contract size for hedging FKLI is 50. 20 million times 90% of hedge times 1.65 beta. How we get 1.65? Okay, actually a market is 100 or 1, so that the portfolio 65 will be add to. That's why it turned to 1.65. For future market, the open market will be on short position since we are expecting price in the future will decrease. For now, we need to sell at 387 KLCI in September at 15.33 ringgit. However, for closed market, it will be inverse relationship, which means long position. On the future market, we'll buy 3x7 FKLI in September at 14.83. How we get 14.83? It will get from 15.33 minus 50. So, equal to 14.83. For cash market on September, the actual price are decreased. So, it will buy 20 million FKLI contract at 14.83. For cash market position, 14.83 minus 15.36 divide 15.36 times 20 millions times beta. So, equal to negative. However, for future market position, sell minus buy times number of contracts times contract size. So, equal to 967,500. Okay, for price value, RM20 million minus 1138,671.88. So, equal to 18,861,328.12. For the net effect, the price value plus future market position. So we can see that hedge is bigger than naked. So based on the result, hedge is bigger than naked, right? So it will achieve hedging objective and future market manage to protect price value.
Thank you Izzati for the explanation. Now we are moving to the next topic, which is speculate, that will introduce by Nurul Liana binti Jamil.
Assalamualaikum warahmatullahi wabarakatuh. I'm Nurul Liana binti Jamil from JBA2724C. I will answer the question for speculating of FKB3 products. I choose past question from FIN645 or 641 or 649, speculation FKB3, July 2024, question 2A. I will begin to answer the question for 2A1. The question is to prepare the market position from 20 May to 24th May based on the above given closing price. So, firstly, I will calculate the initial margin. The initial margin that the question above is given is Rn6000. So, I will times with 10 because 10 is the number of contract of FKB3 product. So, after I times the number of contract, I get the Rn60,000. So, for the maintenance margin, the question above given Rm4500, so I will also times with 10 because 10 is number of contract, and I will get the answer Rm45000. The trading is start from 20th May until the 24th May, so I will prepare the market to market. 20th May, the entry settlement is 97.52, and 20th May closing settlement is 97.43, and the amount balance is Rm60,000. So the profit or loss I get in the day 20 May is I get loss, which is negative 2250 with the margin amount balance 60,000. For 21st May, the closing settlement is 97.56. I get the profit is 3250. So for the 21st May, the closing settlement is 97.56. I get the profit the 3250 with the margin amount balance 63250. For the 22nd May, the closing settlement is 97.45. I got the loss, which is negative 2750 with the margin amount balance 60500. For the 23rd May, the closing settlement is 7.39. I got the loss, which is negative 1500 with a margin amount balance 60,000. And the last day trade is 24th May. The closing settlement is 98.05. I got the profit, which is 16500, and the balance margin amount is 76500. So the overall profit or loss I get for 20 May until the 24th May is Rm16500. I will plus the profit or loss from 20 May until the 24th May. For the second question is calculate the profit or loss when he closed out his position on 24th May. So I will calculate the profit or loss using the same formula, which is sell minus buy times number of contract times size times basis point. Because of this FKP3 product, so the basis point is 100. So the profit or loss is the equation is 98.05 minus 97.43 times 10 times 25 times 100. So I get the profit, which is Rm13250. The other equation that we can use to make sure the answer is the profit is correct is Rm is 76500 minus 16,000 minus 3250. I get Rm 13250. So the two both equation we get the same answer. For the last question is to determine the leverage effect if he closed out his position on 22nd May. So in this question, I will calculate the changes in price and changes in return. So changes in price, the equation is 97.49 and 97.52 divided by 97.52 times 100. The answer I will get is negative 0.0718. And the changes in return is 60500 minus 16,000 minus 2250 divided by 16,000 plus 100. So I will get the last answer is negative 2.1967. Changes in price is less than changes in return. That means it is a good and favorable situation. Thank you. So that's all from me.
It's a very clear explanation by Liana. Now we are on the third topic, which is arbitrage, that will presenting by Putri Nur Zurin binti Jamaluddin. But before that, let me read the question. The question is, a dealer believes there might be a possibility for an arbitrage between the physical and futures market for the crude palm oil. In July, due to market instability, he is prepared to accept 10,000 tons of his arbitrage operation in accordance with the assumption. For him, to the following information is available. Cash price is Rm 4,200. September FCPO is Rm 4280. The borrowing rate is 5%. The storage cost per month per ton is RM6.
Good morning everyone, I am Putri Nur binti Jamaluddin. Today I will be presenting a case of arbitrage involving crude palm oil futures or FCPO. Next, let's look at a question on arbitrage in the FCPO market. A dealer suspects there may be an arbitrage opportunity between the physical and futures markets for crude palm oil in July due to market instability. He is ready to handle 10,000 tons for these operations. Here is the key data given, dated July 2. Cash price is RM4,200 per ton. September futures price is at RM4,280 per ton. Borrowing rate is 5% annually. Storage cost is RM6 per ton per month. The idea here is simple. If the futures price is high enough to cover the cost of borrowing and storage, the dealer can buy in the spot market, store the goods, and lock in a profit by selling futures. We estimate that the holding period is 76 days from July to September. With this, we are ready to solve these questions. Firstly, question Roman 1. Determine whether there is an arbitrage opportunity. On July 2, the spot price of CPO was RM4,200 and the September futures price was RM4,280 after using the fair value formula with 5% interest and storage cost. The fair futures price is RM4,247.53. Since the actual future price is higher, there is an arbitrage opportunity. Next question, Roman 2. Strategy to take advantage of mispriced futures. The dealer can borrow money to buy 10,000 tons of physical CPO at RM4,200 and store it. At the same time, he sells 4,000 September future CPO contract at RM4,280. In September, he delivers the CPO to settle the futures. This locked in a profit from the price difference. Moreover, question Roman 3, calculate the profit or loss. The dealer sells RM4,280 and buy at RM4,200. After subtracting interest and storage costs, the total arbitrage profit is RM212,000 and RM821.92. This confirms that trade is profitable. Last question, Roman 4. Difference between spreading and arbitraging strategy. Arbitrage involves buying spot and selling futures to profit from mispricing, and it is low risk. Spreading means buying one futures contract and selling another to profit from the price difference, which is more speculative.
So next topic is about the spread that will present by Aisyah Atira binti Arifin. But before that, let me read the question for a better understanding. Project a decline in interest rate over the next several years. She wants to take advantage of the chance that presents itself that will execute a spread trade between the two open futures contract. The code for MBS futures at the Bursa Malaysia Darul Berhad is following as follows. First is September 2024 FMG3 is 108.12. Second is December 2024 FMG3 is 108.44. March 2025 FMG3 is 108.24. First question is explain the type of spread trade the analyst plan to execute based on the information given above and its benefits. The second question is discuss on the trading strategy that the analyst would take from the expectation and interpretation she has a market condition. If she were a trade 6 futures contract each. The third one is outline the complete trading activity above with the following futures code price at maturity. First is September 2024 FMG3 108.60. December 2024 FMG3 is 108.86. March 2025 FMG3 is 108.
So hi everyone, I'm Aisyah, and in this video I'll be walking you through an intermonth spread trading strategy using MGS futures contracts. So this example is based on question from FIN549 or FIN645, specifically the July 2024 question 4A. So let's begin by understanding the background. So investment analyst is anticipating a decline in interest rates over the next few months. Since bonds prices typically rise when interest rates fall, so the analyst decides to execute a bullish market spread trade using MGS futures on Bursa Malaysia derivatives. So the futures codes are as follows. September 2024 FMG3 at 108.12, December 2024 FMG3 at 108.44, and March 2025 FMG3 at 108.24. So based on this market outlook, the analyst chooses a bullish intermonth spread strategy. This means taking a long position in the nearer term contract and a short position in a further term contract. So the idea is that if bond prices rise, so the nearer term contract will increase more than the further term one, leading to a profit. So this type of strategy is considered less risky than outright futures trading, as it focuses on the price difference between contracts rather than absolute market direction. So now let's look at the trading setup. So on the current date, the analyst buys December 2024 FMG3 at 108.44 and sells March 2025 FMG3 at 108.24. So it's resulting in an initial basis spread of positive 0.20. So the expectation is that this spread will widen, meaning the price difference between the two contracts will increase in favor of the analyst. So fast forward to contract maturity. So the futures prices have changed, which is December 2024 FMG3 increases to 108.60, while the March 2025 FMG3 rises to 108.86. So the analyst closes the positions accordingly, selling the December contract at 108.60 and buying back the March contract at 108.86. So let's calculate the outcome. For the December long position, the profit is 108.60 minus 108.44, which gives a gain of positive 0.16 points. So for the March short position, the loss is 108.86 minus 108.24, resulting in negative 0.62 points. So therefore, the spread moved from positive 0.20 to negative 0.26, so a change of negative 0.46 points. Now let's compute the spread profit or loss. So using the formula, profit or loss equal to spread change times number of contracts times basis point value and minus commission fee. So the final result is a net profit of 3,060 ringgit Malaysia after accounting for commission charges. So in summary, this strategy shows how futures traders can profit from changes in interest rate expectations using intermonth spreads. So even though the March position ended in a loss, so the December contract's gain was stronger, And that's the power of spread trading. It balances risk while still allowing for meaningful profit.
For the last topic is about the intermarket spread that will presenting by JP Morgan Capital Debt expect the interest rate fall in coming years. She would like to profit from the opportunity and plan to implement a spread trade between two available future contracts. The following is the quotation for MGS future in MDEX today. For the September 2017, FMGT contract is 106.14. December 2017, FMG3 is contract 105.64. For the March 2018, FMG3 contract is 105.34. So for the first question is, explain the type of spread trade the analyst plan to execute and its benefit. The second question is, discuss the trading strategy that the analyst would take from the interpretation of the market if the analyst were to trade 5 future contracts each. The third question is, outline the complete trading activity above with the following futures code price at the maturity. First is December 2017 FMG3 contract is 105.80. March 2018 FMG3 contract 105.95. June 2018 FMG3 contract is 106.15. Next question is, determine the spread profit or loss if the commission charge are 50 ringgit per contract. So for the answer of this question, first question is about the explain the type of the spread. The answer is the analyst plan to execute a calendar spread trading strategy. This involves taking long and short position in future with a different expiration date. This strategy benefit from the expected interest rate change, reduce risk, and is cost efficient. So for the second question is about discuss the trading strategy. So the answer is, first is we expect the interest rate to decrease. So what we're gonna do is long near and short far for the futures market. For the third question about the online, the complete trading strategy, the answer is first is calendar spread. We're using a same underlying asset FMG3, different delivery date December 2017 and March 2018. This is the calendar spread trading strategy. For the December 2017, at the TO we long 5 at 106 and 64. For the March 2018, we short 5 at 106.34. For the T1, we short 5 at 105.80 and we long 5 at 106.95 for the March 2018. So for the profit or loss in December 2017, we got 0.16, and for the March 2018, we got negative 0.61. So for the total profit or loss, we got negative 0.45. For the next question is about determine the spread profit or loss if the commission charge 50 ringgit per contract. So we are using, to answer this question, we are using the formula profit or loss spread times NOC times 100 times 10 minus the 50 times NOC times 2. So if we convert to the formula, is negative 0.45 times 5 times 100 times 10 minus then 50 times 5 times 2. So we got the answer is negative RM2750. So that is the 5 strategy from our presentation, which is hedging by Nur Izzati binti Muhammad Sofyan, speculate by Nuruliana binti Jamil, arbitrage by Putri Nur Ainzurin binti Jamaluddin, intermonth spread by Aisyah Atira binti Arifin, and intermarket spread by Muhammad Aidil bin Zahano. Thanks for the attention. Thank you.